Hello and good afternoon. I welcome you to today's hot topic webinar here together with Admirals on it's Wednesday, the 2nd of June, 2021. And we have, in fact, a very fascinating topic today. We want to have a look here at the question on how to prepare for the inevitable inflation and where to invest your money. So that was where this is, in fact, the official topic or official headline of this webinar. But you can see if you're watching this on YouTube right now. By the way, if you like what you will witness in the upcoming 45 to 50, 55, probably 60 minutes, please leave a thumb up here, leave a comment in the chat box. If you have any questions, feel free to ask them. I have also the YouTube live stream open, which means you can ask your questions here. I'll answer them in real time. And yes, so coming back to the topic of this webinar, so AMC and inflation is the topic. Is there a correlation? And I mean, some might probably say, well, that's probably a little difficult to see this a correlation. But the current developments in the stock. So just to give you some numbers right now, so in about 30 minutes, we'll open here. Wall Street will open. AMC has, as of now, already traded nearly 30 million shares. Average traded volume per day is 88 million shares. The stock is gapping up over 20% again, is currently trading slightly below 40 US dollar. So to make long thing short, what's going on there? We don't want to dig too deep into this matter. In fact, I don't see any real true, let's call it, fundamental driver for this price action. It's more like very likely that it's just too much liquidity in the system, which is currently driving stock prices to these elevated levels. You probably have heard about the GameStop saga at the beginning of the year, January. We've seen also AMC back then with massive volatility. So what happened there? Well, it was just that there was a forum called Reddit Army, we can call this. There was some retail traders who talked to each other and then said, yeah, let's squeeze some big hedge funds here. Let's squeeze them out of the business, and they squeezed the stock higher. And in fact, back in January, around GME, we saw a hedge fund going bust. Melvin Capital, probably you remember the name, was bailed out from Citadel, and another hedge fund from Steve Cohen. He's the owner of the Mets. I'm not sure about the 70.72, something like that. I'm not sure, but it doesn't matter. The thing is, how is that possible that such excesses take place? And I think the main reason for that is because there's too much liquidity in the system right now. We will dig into details around this here, into the too much liquidity aspect in the upcoming minutes. It is also a big topic right now if you look at not just AMC, but also the developments in the repo market, for example. Repo markets, this is where short-term liquidity can be found and is found, especially from investment banks to hold keep their business afloat, let's say. To make long thing short, don't get into too much depth here. So there's so much liquidity right now that reverse repos are shooting to the moon, in fact. And there's so much liquidity pouring back to the Fed every day now with half a trillion, up to half a trillion US dollar, that the question arises, well, is it now time for the Fed to taper, to probably start to reduce their current asset purchases, currently in the range between 80 to 120 billion per month? And all this brings us to the main topic, in fact, inflation. Too much liquidity, not that many goods. Well, that naturally results in inflation picking up. We can see this at several in several economic projections already. Indications yesterday, for example, ISM manufacturing numbers came in today. No, tomorrow on Thursday we will see non-manufacturing numbers around the ISM being published. But all this brings us back and all the time back to inflation. And the question, what will happen if inflation picks up, which is obviously inevitable if you look at the recent numbers around CPI, PCE, and so on and so forth. And this is exactly what today's webinar will be around. And so now what I want to do is I want to share my screen now after this quite extensive introduction. So first of all, we want to have a look here at the rebranding currently taking place at Admirals. So Admiral Markets, the broker, is still there, but it's rebranding now and it's becoming Admirals. And why is this? Because as a classic broker in this FX and CFD industry. Here in Germany, for example, where I'm located, Admirals is known as the DAX expert, as the probably best broker out there when it comes to DAX trading in terms of spreads, or execution, trading conditions in general. And but they make the next step now, become a broader financial service provider, let's call it, offering a credit card, for example. They are already a multi-asset broker with offering with their invest solution physical stocks. To make a long thing short, give admirals.com a deeper look the website, look it up, and you will definitely find something which will suit your overall interest when it comes to financial questions. And in addition to that, we are also very active now building the social media front, and there's now the Instagram page I want to point out here. So follow Admirals on Instagram here at Admirals Global, in fact, for further information, upcoming events, but also current hot offerings, for example, being offered from Admirals. And that's it around the introduction. Now let's have a look at today's agenda and what we want to take a deeper look at. So I prepared several, in fact, screenshots. So we will make, or we will have plenty of charts now in the upcoming minutes here, and I will talk around these charts. So just to prepare you, usually if you, this is not the first time you're following a webinar with me, Hot Topic, or also Trading Spotlight webinar, usually each Friday, this week with Paul, but here around this topic at the end of this presentation, I usually use quite, let's say, texty presentations, let's put it that way. So there's usually lots of text, but in this case, I just wanted to point out my thoughts here in a visual way to give you a better idea of this. But what the main topics we will cover here, and which questions we want to answer is, first of all, why is inflation a serious threat? Why, or what does the FED and the ECB balance sheets in this context play? Which role do they play? We want to have a look at the US federal budget. Right now, we have seen debt levels we haven't seen since World War II, in fact. And then I will show you something which will probably ring a bell and give you already an idea. I mean, the last point pointed out already why are gold mining stocks of high interest, but also especially why gold is very interesting. The question is, what happens if inflation picks up and real yields continue to drop further? It's not the first time that this happened. It happened already in 1974, and it happened also in 1978. And you will be surprised to see this chart. And I came across this chart. Initially, when I prepared this here, it was more like I was thinking about, okay, yeah, there's a correlation. Let's point out the correlation. But yesterday was a coincidence, pure coincidence. But I also recommend you. By the way, I'm also active on FinTwit, so you can follow me on Twitter at Jens Klatt FX in this case. And I'm quite active there. And there's a prop trader I also follow, and he pointed out something in terms of real yield and gold here, something I wasn't aware of because I haven't looked at the history as long as he did here, or the time frame was much longer than the one I planned to illustrate you. He went back until the 1960s. You will be really surprised to see this chart and what upside we probably have, especially when it comes to gold. But first of all, let's start here with answering the first question. So first of all, we want to answer the question, why is inflation a serious threat right now? Personally, I have to say, I'm sometimes surprised. I mean, I'm located in Berlin, in Germany. So as you may know, inflation, this is like, if you want to scare Germans, you just open a discussion with, oh, by the way, we have some inflationary pressure here, and then you have you get someone, you can scare him really, not to death, but close to. Why is this? Well, because the dark history of Germany, it didn't really start in 1933, but it started already around 15 years earlier, after World War I, and with all the developments around the so-called Weimarer Republik. That was that was the Second Reich, I think we can call this. It wasn't the Third Reich, but it was the predecessor of that. So around this time, there was a massive bull run happening in equities around the globe, especially in the US. You probably have heard about the big crash then which happened in 1929, which resulted in the Great Depression over there. Also, pointing to certain political developments around, for example, a prohibition of gold and all this. Here in Germany, inflation picked up. You probably have seen some pictures with people having I don't know how it is called. These wagons. Sometimes it's a wagon full of money, which you used to buy bread. We had hyperinflation over here, and people died. People lost everything they had, and that was in fact the beginning of this dark chapter in history, because most of the Nazi politics really built on these fears and to make everything better. That was the simple, very rough, but all in all story being told here. So inflation is a big topic here in Germany. Inflation is currently picking up, and we are right now doing something which happened already back in the 1920s. So the differences are not that great. In fact, what you have is you pump more and more liquidity into the system back then to finance the debt out of World War I. Right today, to finance all the developments around the corona pandemic, the lockdown, and so to keep businesses afloat, respectively the economy going, and to finance all this debt being made right now. For example, not just by the European government, let's call it, or let's say a German government in this context, but also and especially in the US, with the US government handing out direct checks to the people, and resulting, by the way, for example, in massive up runs in retail sales, if you've seen the recent numbers there. So you pump in money. Central banks are producing this money out of thin air, out of nothing. And on the other hand, you don't have production at the same high level, counterweighting, let's say, this massive liquidity access. So you have more and more liquidity being delivered to the markets, and there are no goods being created. And that being said, means that there's naturally inflationary pressure pushing prices higher. That's the natural result out of this. And this can be seen already in several economic projections, which were delivered in the recent past, but also which will be seen in the upcoming months, in fact. And it's pointed out, it's right in front of us. So websites like tradingeconomics.com, for example, they clearly show here that this is something which is not just a thought or something, but this is common sense and something we can see at some angles already. We can feel it. So, for example, a good friend of mine, he is he's a painter. I think this is the right word for this. So he's painting walls, and you build a house, and then you have to get a nice paint on your wall. And this is what he does. He says that prices have doubled within the last 12 months. There are other guys, for example, building a house right now, friends of mine building a house, saying, yes, I have a fixed price. Unfortunately, no one can deliver, for example, lumber. You have seen the developments in lumber prices shooting through the roof. We will have a chart here in a few seconds. So the thing is, you have a fixed price. You probably bought it, let's say, for 10,000, but the one who delivers the lumber probably can't deliver it because there is no lumber being out there which can be bought at a price so that this instance here, who delivers the lumber, can deliver it at a price where he stays in business and can also make some money to make a living out. And these disruptions in the supply chains can be seen and are pointed out in several PMIs which were published in recent weeks, in fact, in recent months. So Here, I underlined the part. It's from Market Economics. It's a snapshot from there, but it was published on tradingeconomics.com. There you can read, although firms were able to partially pass on higher cost burdens, this is the next thing. I mean, you could easily pass it on, but you need someone who can pay for whatever you deliver, right? So, I mean, you can now say, for example, the color my friend delivers to a client, you could say, yes, easily. I could say it's not 50 euros anymore. It's now 100. The only problem is no one will pay you 100 euros for this kind of color or paint, whatever. This is just not happening. Or the guy can't really afford it anymore because he lost his job or is right now getting less money than he used to get. So pass on higher cost burdens, supply shortages, and the potential for future strain on capacity pushed output expectations down to their lowest for 7 months. Finally, supply issues weighed on business confidence in May. The degree of optimism remained upbeat on average, but dipped to a 7-month low amid concerns regarding future supply flows. So that was a number which was just published 2 weeks ago or something. So it's market data which is fresh. It's out of the website from yesterday. So here is the ISM non-manufacturing. Next numbers will be published tomorrow. Here are the numbers from last month. They dropped in April 21, and also here I underlined this part. The service measure of prices paid by service industries rose to 76.8, the highest reading since July 2008. It was at the beginning of the great financial crisis, if you remember. So to give you here a clearer picture, that's a screenshot I took from Zero Hedge in this case. So I haven't the source here, but just so you know that. It's ISM services and here prices being paid. So what you can see is that there is a clear push higher. And as you can see here, highest levels since 2008. There was a big difference between 2008 and now. Back then, we had some height, let's say, we can fall from, and where, for example, interest rates in terms of the Fed were at 5.5%, if I'm not mistaken. Right now, we are at 0. So there's no further height. So we are already at the lowest level possible when it comes to yields, in this case, or respectively rates, which means nothing more. So that the only chance to deliver more liquidity is by pumping in more liquidity, for example, by expanding their already massive expanded QE programs, more liquidity, expanding their balance sheets. And so what does this mean over the long run? Well, it means nothing more that prices will naturally rise. You have less goods, you have more money flowing around, which means nothing more, prices will rise, inflation picks up. Something we can here, for example, see when it comes to lumber. Or put it differently, I made a joke out of this. That's a chart something 3 weeks ago or so. What I have here is lumber, which pushed up right now. We've seen already a pull in here. So we came already from this extended mode. We pushed lower, but we were about to overtake gold here in terms of prices being paid for lumber. So just imagine that you have a house on a tree. So my 4-year-old probably comes out and says, "Hey, Dad, will you help me to build a house on a tree?" And I say, "Yes, great, but we don't take lumber, son. We don't take lumber. We take gold now because it's cheaper." I mean, this is what's happening right now. Okay, so and right now, right here, you will look at your screen, and you will probably laugh about this, but this is a serious threat to all of us, because there will be a time once we can't afford these goods anymore, and we can already see it at several instances. Probably we just post it below that video or in the chat box right now, if you can feel this yourself, if you can see that in some areas of life, which I probably do not even thought about, but where you can also see this happening. I mean, the inflation already took over the last, let's say, 5 years. I used to say something like, when I went to the supermarket when I was a student 10, 15 years ago, I had something like 50 cents for a beer or something with a friend together. It was nothing. This beer today is €1. So price is doubled there. So we can already feel this inflation, which we can see on a day-to-day basis, for example. But still, as of now, everything was fine because everyone had a job and everything could be made to money. So we made money out of, let's say, producing YouTube videos, for example. So it sounds ridiculous, but to be honest, I mean, the longer you think about this, there's no true good. Okay, so hopefully you'll get something out of these videos. If I produce a video, my first thought is, how can I make the viewer better? So how can I deliver value? How can I help him to use this knowledge I produce here for him to make to have an impact on his overall life, in my case, on his overall trading. But this is not necessarily the case if you produce a video where you just have some kind of, I don't know, my 4-year-old sometimes tells me that he's seen a video where another 4-year-old is driving around with a car. And then he tells me, hey, Dad, I want this car. Yeah, to some extent, I understand that. That's the new way of commercials taking place right now. But there's no true value added. I mean, at least not that I can see that. So why do I say that? Well, because all this right now is taking place at an accelerating pace. And the reason for that can be mainly found here in these developments which take place and bring us back, in fact, to the introduction and AMC here. So what we see here is an overlay of the balance sheet from the FED and from the ECB. By the way, let me just please check out here. I just wanna see. That's a little unfortunate because I can't see the questions here. Where are the questions? Okay, so probably here. No, that's not good. Okay, cool. So where are the questions? Why can't I see the questions here? That must be there. Let me just, okay, it's over here. So I probably better here. So here's the chat box. Okay, yeah, thank you. Yes, I was in fact looking here for this. I'm not even sure if you can see this, but I was looking for this for this header here. Okay, let's have a look now at the FED balance sheet. I mean, probably you have seen this already. And what we have here, what I haven't done, but you can do it yourself, in fact, is you can overlay an equity chart, S&P 500, NASDAQ 100, the DAX in case of the ECB balance sheet, which you can find here in black, by the way. And you can overlay these charts. And then you can, in this context, see that there's a direct correlation between the run-up in equity prices and the balance sheet, in this case, of the respective currency or of the respective country in this context. So FED, US equities and all this. I mean, this is not the first time that you see this, but we have asset price bubbles. And the thing is, I mean, at the end, we could easily sum this up and say, well, the rich get richer. Put it that way. Okay, so if you're Bill Gates and if you had, let's say, like 50, 60 billion in 2010, now you're worth, let's say, 200 billion, just to give you a number. I don't know whether this is a true number, a correct number or not. It doesn't make a difference for him. And why is that the case? Well, because most of his wealth is concentrated in his portfolio, and especially in, obviously, Microsoft stocks, or take Amazon CEO Jeff Bezos in this case. So probably it's a better way to put it. I mean, this is probably the only guy out there who got divorced and is richer after getting divorced. I mean, that's showing how crazy this world has become, right? So, and the only reason why this is the case, it's because here the central bank, in this case the FED, the blue line, they are expanding their balance sheet at an accelerated pace here and pushing probably the envelope a little too far right now. Because what happened already, and could be seen, what happens just in case you remember this year, that was our reduction of the balance sheet runs on autopilot. That was in 2018. Yes, that was over the 2018. And in the fourth quarter, especially around Christmas, By the way, I was really annoyed by this because Christmas is usually time you want to spend time with your family, and you just don't want to follow the action on your smartphone. And that was, by the way, the reason why I and my wife decided from this Christmas onwards, 2018, to shut down the smartphone altogether. Not just mine, but also hers, and not looking at the smartphone for these 2-3 days in Germany, so around Christmas. It was because there was the highest level of volatility which has ever been measured back till the 1920s. And it came out of the fact that the Fed, shortly before this massive volatility took place, market participants started to fear that the Fed is taking her so-called put away. What's meant by this? Well, the Fed put, as we refer to this, is usually the support from financial markets, respectively equity markets in general. If volatility gets too high, usually the Fed steps in and delivers liquidity for the markets to calm markets down. And this is happening, in fact, since 2008, as you can see here. So there's this massive push up higher. And from there, we never looked back. But in fact, there was this small reduction. In fact, this small reduction resulted in a drop of nearly 20% in the S&P and NASDAQ. So you can imagine what happened if they continue to do that. Volatility would have gone crazy. And then the Corona pandemic hit. You remember that was last year in March around. And what happened was that we now pushed equity prices even further. And market participants, and especially retail traders, this is the big problem with that. They don't really know what to do with their time. They don't know what to do with all the money flowing around. And that's one of the reasons why then, for example, such developments as currently taking place in AMC are happening. Right? Because market puts, especially retail traders, they start to play around with the money. It's as if it's worth nothing anymore. It's like, okay, I'm gambling around a little, and well, it's enough money is there. The thing is, again, right, as of now, there's so much liquidity. By the way, I have just to double check something here. One sec, please. Okay, one sec. So let me just take a screenshot here from something. This is again the time when I have to check the numbers here. So you probably have wondered why I know that AMC as of now is trading 33 million shares, has traded already shortly before the open. That's because I have a watch list open here, and I have to use the data for my trading session, which starts in around 20 minutes then after this webinar. And I have to just check here the stocks I consider to be hot today. It's not just AMC, but I think today also we'll see some serious volatility in NEO. Had a very, very strong run yesterday. And also probably have seen that yesterday after markets closed, Zoom delivered numbers were really strong. And when looking at Zoom, you have probably seen that then the stock went up massively due to the pandemic last year. No big surprise. Everyone is using Zoom, as we do right here, right now. Great product, no question about that. And that has resulted in a massive run higher, also driven by massive liquidity injections from the Fed, and by the fact that it's also considered a true growth title. And the stock topped out around October 2020, and then took a hit here of around 50%, nearly 50%. It's still, as of now, trading 40% below its all-time highs. You see still strong numbers. Growth outlook remains stable to being upped from the management, which is then raising the question if the stock is probably cheap at the current levels, and probably could see a drive higher from there, especially after the initial a push lower after the numbers were released yesterday. But this is something just for your information, but to some extent also the topic here for today, because the developments there also go hand in hand with the massive central bank expansion. The only problem is that there's so much liquidity right now that repo markets right now, they see capital and too much liquidity going around. So let me just we don't want to go into too much details here around repo, but just to make long thing short, a repurchase purchase agreement, in this case, a repo, is nothing else than I have a business and I have to stay afloat. For example, I drive a car. Let's say I need a car to get to my client, and the only problem is I don't have money available right now to pay for the fuel. So I go to a friend and say, hey, could you please give me 100 euros so I can get fuel, and then I can go to the client, do whatever business, collect the money, and repay you. And he says, yes, I'll do that, but I want kind of collateral for this. Collateral, like, what can you offer to me? And let's say I can offer him, let's say, a hammer. I hand over the hammer and say, hey, this is, I guarantee you to buy it back with a small commission included. So it's not 100 euros, let's say it's 101 euros. And then I go to the client, I do whatever business I do, and collect the money. He pays me, and I go back and repurchase here my hammer and give him the money back. So this is in fact a reverse repo, which is happening right now, because I give him the money back. The more money goes back, the more there's a sign that there's too much liquidity going around right now, and it naturally results in distortions of the overall market. And how can they overcome this problem? Taper their asset purchases taking place right now. That's one of the reasons why the upcoming 2 weeks will be of interest for us, because on the 16th of June, we'll have the next FED the rate decision. And the thing is that there is at least some fear that there could be some taper announced, or at least that their rhetoric goes into that direction, that this could be something which could be around the corner in the upcoming months, let's say. And what happened? Well, what happened here was there was massive volatility in equity markets. October, November, December 2018, look at the charts. And now look at from which heights we come here. If they start to reduce their liquidity injections, this will cause massive volatility in markets. And that's why it's so of importance. But on the other hand, the more money you keep on pumping into the market, the higher inflationary pressures build, and the more this becomes a serious threat. So to make a long thing short, we shouldn't expect here this development to we shouldn't expect it to stop. It's more likely that it will continue, that the balance sheets will continue to grow, while the goods and the GDP connected with that won't continue to rise, which is then meaning nothing more. By the way, in this context here, the federal budget. So looking here at the numbers, that was in it's a chart from, I'm not really sure, it's from the St. Louis Fed. I'm not really sure. I think it was midst of 2020, I think 2020. But as you can see here, going back till the 1920s, 1930s, you can see that the current levels here, and this number already increased massively. We've seen here the highest deficit as percentage of GDP since Second World War II ended. And that being said, already tells you need to make more and more and more and more debt to keep the economy going, to keep businesses afloat. And this money needs to be financed somehow, because the problem now is that, and there we come back to another asset class, which was of high interest over the last months, Bitcoin. So all the discussions around Bitcoin, the mistrust in the financial system, in the governments around the globe, or also in the central banks creating money out of thin air. This is a direct statement from people. They don't want to argue with government officials. They do that a different way. They take out the money out of the US dollar, out of the euro, and invest it here in safe haven currencies like Bitcoin, or, well, is Bitcoin really a safe haven currency? Because there now the discussion starts. But if I see an investment here in Bitcoin and the current run up, one of the reasons for that is not just that it's a speculative access, but it's also a clear sign that people start to mistrust the government and their overall monetary policy, and how to keep the system afloat, respectively, how to overcome this negative impact of the pandemic. There's lots of mistrust, as you can see in several social media channels, also in the media in general. Newspapers are questioned, and all this is a clear sign that people start to really not believe any story anymore, which is which is delivered to them, which is naturally resulting in the government now coming out and saying, hey, by the way, we have to finance all this. We need money to invest in the overall infrastructure, or we need money to, for example, hand out these stimulus checks. Well, where do you get the money from? If people don't trust you anymore, you go to someone who trusts you. If you destroyed all trust around you, well, then there's a lender of last resort. And in case of the US government, it's the Fed, it's the Federal Reserve, and they print money out of thin air to finance all this debt. On the other hand, there's not enough goods being produced, which is building inflationary pressures. So you can see it, all this plays together somehow. So since we shouldn't expect here this to stop, because there will massive developments taking place also in terms of how to finance all this, that we should be aware of the fact that here we now have to seriously think about how to save our savings. And in this context, by the way, this is a chart from Jerome Blokland, also a must follow in my opinion on Twitter. This is now bringing us to the next question here on real yields. So just to give you an introduction on what is real yield, what is this? What you do is you look at the current interest rate, for example, 10-year US Treasury yields pay, in this case, here T-note futures. And right now they're at, I think, 1.6, if I'm not mistaken, 1.6% per 10-year on 10 years. So latest CPI numbers, which were published, they came in at the beginning or midst of last month in May, they came in at 4.2%. So there's a difference, which is minus 2.6%. And this difference, 2.6%, this is the real yield. So you're not getting enough yield to overcome inflation in this context. So if we talk about gold especially, then you probably have heard about this classic saying, gold is an inflation hedge. This is not true. What gold is in fact, it's a hedge against negative and even more negative real yields. This is what is true. And there's a positive correlation. So the further real yields drop, the more likely it is that gold will continue to rise. And as you can see here in this context, we already took on bullish momentum. So here in blue, I hope that you can see this. In blue, this is gold, while this white line here is showing that as of now, real yields dropped to the lowest levels since the late 1970s, early 1980s. And as you can see here, since we should expect, given all and everything I just presented to you, that real yields will continue to drop further over the next months, what I want to say about that is, well, it's likely that we will reach real yield, negative real yield levels, as we've seen in the late 1970s, respectively early 1980s, respectively early 1970s here. So this chart, as you can see here, is going back to the 1960s. And that being said, what is of interest here in this context is in 1974 and in 1978, when real yields showed exact this tendency as we get to see right now, the price in gold doubled. Okay, so if you ask me now, do you think gold is a great investment? Well, if you think that history repeats itself, respectively, if you think that history at least rhymes, then chances are good that gold is probably a serious investment opportunity to hedge against the upcoming inflation and respectively to hedge against this. It's not a monster, but it's a serious threat, let's say. Serious threat that inflation will continue to rise. As I pointed out, several aspects point in exactly that direction. And the last time that happened, that was when gold prices doubled within months, in fact. So it didn't really take that long for gold prices to double from the current levels. I'm not really saying that gold will push to $4,000 within the next 12 months, but at least from a long-term perspective, I don't want to be short gold. So I could really expect, or I really expect gold to continue to outperform. The only problem with gold is now that gold is probably not the most interesting investment opportunity when it comes to cash flow generation. Because, and this is the thing, just imagine now, you want to save your savings and you want to hedge against this inflationary pressure building. So the only problem is now in the current environment, probably you've lost your job or you're not making as much as you used to make, let's say 16, 18 months ago. And that being said, now brings up the question, if I buy gold now, I hedge, but the only problem, or I hedge against this inflation, but the problem is I also have to pay my bills, respectively, I have to make ends meet, I have to pay rent, whatever. So gold is known for not generating any cash flow at all. So why should I, or how can I invest in gold in this context in a smart way to also get my hands on kind of a cash flow? And here in this context, we are coming back to something we also presented in earlier webinars around gold miners and developments we've already seen here. This is a chart from Crescent Capital, also a must follow in this context when it comes to precious metals and investments in precious metals, a must follow on Twitter. It's with data from Bloomberg, but still what you can see here is this free cash flow yield, which turned positive going back till the 1990s. So the question now is, what is a free cash flow yield? And so in this context, let's bring up this number, define it. So free cash flow yield is a financial solvency ratio that compares the free cash flow per share a company is expected to earn against its market value per share. And the ratio is calculated by taking the free cash flow per share divided by the current share price. Looking at here at this chart, it shows that it has been negative for gold mining stocks, especially like Barrick Gold, like Newman, for example, has been negative for nearly 25 years, all the time. So they have been cash destroying machine, let's say. But this turned positive here last year around the Corona pandemic hitting. And what it means is, in fact, so to make this more to make this more to understand it better, the higher, it means nothing more than that the higher the free cash flow yield, the more likely a company is generating enough cash to easily not just satisfy all its debt and other obligations, but also to include dividend payouts here, or to pay dividends here, and to make sure that they can pay a dividend. That being said, brings us to the point that we know that there's a high positive correlation between gold, precious metal, physical gold, which I also recommend to have to make part of your overall portfolio. But if you're looking for a dividend component within your portfolio, which is highly positively correlated to gold, then gold mining stocks like Barrick Gold, like Newman, but also like the gold mining stock ETF GDX, for example. You can all find this, by the way, on the website admirals.com, and there you have the possibility to look up products, and there you have all ETFs being listed, shares being listed, and I can see which ticker symbols you have to look for if you plan to invest part of your portfolio within this within these stocks or ETFs. And yeah, so that brings us, in fact, to the summary of today's webinar here. So first of all, I think it became quite obvious and clear that inflation is a serious threat with these supply chain disruptions on the one hand, and central banks having no other choice than continuously ballooning their balance sheets further. And that could be summed up to say, well, there's less goods available and more money and fiat, inflation picks up. Simple as that. And so that being said, in such a negative, or not negative, but inflationary environment, usually we should expect real yields to drop, and especially as of now, because usually you might say, hey, if inflation picks up, also the question around central banks arises, they can hike rates. The only problem is that inflation expectations are rising much faster than yields start to push higher. So you could see now an environment, for example, where you see yields picking up, and you might say, hey, this is negative for gold. This is true in a normal environment where we have stable inflation. The thing is only that inflation now picks up too and takes on bullish momentum, accelerates on the upside. And if this acceleration is faster than the pickup in yields, then you usually see negative, or yields turn even more negative, which is extraordinary bullish for gold on the other hand. So picking up in yield does not necessarily mean it is negative for gold. If inflationary pressures pick up too, you see a push higher in gold. And this is usually then positive, not just for gold, by the way, but also for silver in this context due to their negative correlation. And gold mining stocks should be part, in my personal opinion, of a well-diversified, recession-proof, respectively, stagflationary-proof portfolio. So stagflation is inflation picking up and economic growth is stable to negative. So there's some stagnation in economic growth. And that being said, there's a positive correlation to gold in such an environment, stagflationary or inflationary portfolio, recession-proof portfolio. And gold mining stocks are also, as I pointed out, interesting from a cash flow perspective, with free cash flow yield right now having turned positive over the last months and continue to stay positive, which is the first time since the early 1990s. And that's definitely something to keep in mind if you're looking for an investment highly positive correlated to gold and with a cash flow component, dividend payment component attached to that. And yeah, so that brings us to the end of this presentation. Oh, by the way, I'm sorry, this is not Monday. It's Friday. It's Friday. And it's not me, by the way. Join my dear colleague Paul Wallace. I'm sorry. And what he will definitely tell you is he will teach you something here on how to use inside bars for intraday trading, which will include also the question, first of all, the definition. What is an inside bar, and what do we need to be aware of when trading with inside bars? How can we use them in breakout? How do we use them in intraday trading? 2 p.m. London on Friday, 4th of June, 2021. You can check your inbox for the webinar link, or also if you watch this now on YouTube, then please head over to admirals.com, and then you have the educations tab there, the webinars tab, and there you can register under the Trading Spotlight webinar series. So here is the contact details for further information around Admirals. Again, true multi-asset broker with a big portfolio, different services around financial products like credit card, but also CFD and FX broker. And so here's the risk disclaimer. Yeah, that's it. That's it at my end. Let me just see here. Can I? Okay, not really sure. So now the thing is, I plan to switch back. So I haven't forgotten it. Anna, you're my witness. So I haven't forgotten it, but I don't know. I don't want to destroy now this presentation. So I do it here as a small guy in the upper right corner. If you like what you just saw, leave a thumb up here. Subscribe to the YouTube channel. Also turn on the notification. And if you have any comments, questions, well, please feel free to use the chat box below the video here. I'd be more than happy to answer your questions. And so that's it from my end. I hope you enjoyed this webinar, and all the best from my end. Happy trading. Watch your stops. Talk to you next week again. And on Friday, Paul